Welcome back. Today is February 13th, 2026. President Trump says inflation is gone. Jerome Powell says inflation progress has stalled. Official numbers say inflation is around 3%, but nothing feels cheaper. Groceries aren't cheaper. Rent isn't cheaper. Insurance isn't cheaper. Eating out isn't cheaper. So what's actually going on? Here's the truth. Inflation didn't disappear. It compounded. And most people don't understand what that really means. When you hear inflation is 3%, it does not mean prices went down. It means prices are still rising, just not as fast as they were before. That 3% in 2026 is on top of the price increases from 2025, which were on top of 2024, which were on top of 2023, which were on top of 2022, when we hit 9.1% inflation. Inflation stacks. It doesn't reset. That's why nothing feels cheaper, because it isn't. Now here's something even more important. The Federal Reserve's goal is not zero inflation. It's 2%. They want prices to rise every year. That's policy. That's by design. And this is where people start getting uncomfortable. Because inflation doesn't benefit workers. It benefits asset owners. Look at history. From 1971 to 2021, median income rose about 600%. New car prices rose roughly 800%. Home prices rose around 1,200%. College tuition rose over 2,000%. Yes, incomes went up, but costs went up faster. That's the game. And after the pandemic, it accelerated. From 2020 to 2025, reported CPI inflation rose about 23.5%. Reported wage growth rose around 21.8%. Even by official numbers, wages didn't keep up. And that's before we talk about how CPI actually works. Because CPI, the inflation number you see on the news, is an average basket. It includes cars, furniture, electronics, appliances. How often are you buying a couch? How often are you buying a new car? Meanwhile, it underweights things you buy constantly: groceries, gas, rent, insurance, healthcare. So when CPI says 3%, many households feel closer to 5% or 6%. That's why there's a common rule floating around. Take CPI and multiply by 2. Now, I'm not saying that's scientifically exact, but psychologically, that's how it feels for a lot of people. And if your income isn't growing at that pace, you're getting poorer. If your savings aren't growing at that pace, you're losing purchasing power. That's the quiet erosion. Now let's talk about what's happening because of this. Credit card debt is at record highs. People don't want to lower their lifestyle, so they swipe Visa, MasterCard, Amex. But interest rates on credit cards are brutal. That debt compounds faster than inflation. Retailers are reporting a shift. Walmart, Target, Kroger. Consumers are trading down, buying cheaper brands, smaller packages, cutting discretionary spending. That's not a booming economy, that's stress. And here's where it gets even more dangerous. People think holding cash protects them. High-yield savings account pays 3%. Sounds safe, sounds responsible. But if inflation is effectively 5 to 6% for your household, and you're earning 3% before taxes, after taxes you're probably netting 2%. You're losing purchasing power every year, quietly. And you don't feel it immediately. But 5 years later, you wonder why life feels harder. Now let's step back and talk about what inflation actually does. Every time you spend $1, someone earns $1. When prices rise, companies collect more dollars. But who benefits from those extra dollars? Not the worker. The worker gets a small raise. Maybe. The investor gets the profit. Let's say you buy a Chipotle bowl. It was $10. Now it's $15. The employee might get a slight wage increase, but most of that extra margin flows to shareholders. Inflation increases nominal revenues. Nominal profits grow. Asset prices rise. Who owns the assets? Investors. That's why inflation benefits the investor class. If you're not invested, you're just paying higher prices. That's the harsh truth. Inflation punishes consumers. Inflation rewards asset owners. And the system is structured that way. Now, before someone misinterprets this, I'm not saying panic. I'm saying understand the structure. Because if you understand the structure, you can position accordingly. You build wealth in 3 primary ways historically. Starting a business, owning stocks, owning real estate. Starting a business is active and risky. Stocks, accessible. Real estate, more capital-intensive but powerful. Gold, protection play. Crypto, speculative volatility. The key isn't picking one magical asset. It's building a portfolio that compounds faster than inflation. Because inflation isn't going away in 2026. All future inflation compounds on top of what already happened. And government spending remains elevated. Lower rates in the future would increase liquidity. More liquidity equals more inflationary pressure. This isn't fear. This is arithmetic. Now let's zoom out one more level. Why does this matter politically? Because when Trump says inflation is gone, he's looking at the rate. When Powell says progress stalled, he's looking at trajectory. But the average person is looking at their grocery bill, and grocery bills don't lie. Inflation didn't disappear. It slowed from extreme to elevated. That's it. And elevated inflation in a high-debt economy is dangerous because it forces the Federal Reserve into a corner. Cut rates too fast, inflation resurges. Keep rates high, growth slows. There is no painless option, and markets know it. This is not about politics. It's about structure. Now here's the question you need to ask yourself. Are you positioned as a consumer or as an owner? Because inflation is not your friend if you're only consuming. Inflation is tolerable, even beneficial, if you own productive assets. That's the divide, and it's widening. This is part one. In part two, we're going to talk about what happens next, what this means for gold, silver, Bitcoin, what Trump's pressure on the Fed actually risks, and whether the bond market is about to force a bigger adjustment. Now let's go deeper, because inflation slowing to 3% is not the victory lap some politicians want it to be. It's a warning. And the warning is simple. We are entering a structurally higher inflation era. Not 9%, not hyperinflation, but not 2% either. And that changes everything. President Trump has been aggressively pressuring the Federal Reserve to cut interest rates. He wants growth. He wants expansion. He wants markets up. But Jerome Powell is cautious. Why? Because if inflation progress has stalled at 3%, cutting too fast risks reigniting the fire. And once inflation expectations become unanchored, it becomes much harder to control. Now here's the trap. If the Fed keeps rates high, economic growth slows. If the Fed cuts rates aggressively, inflation reaccelerates. Either path has consequences, and markets are starting to price that in. Look at what's happening in gold and silver. We saw sharp drops recently, some of the fastest in years. Bitcoin got hit hard. Why? Because when the market starts believing rates might stay higher for longer, liquidity expectations change. And liquidity drives risk assets. When money is cheap, speculative assets explode. When money tightens, leverage unwinds. That's what you're seeing. Now here's something most people miss. Inflation doesn't just affect groceries and rent, it affects asset valuations. When rates are low, future cash flows are discounted less aggressively. That pushes stock valuations higher. When rates stay elevated, future earnings are discounted harder. That compresses valuations. So even if companies are profitable, their stock prices can struggle. That's the silent repricing. Now layer on consumer behavior. Credit card balances are at record highs. Auto loan delinquencies rising. Buy now, pay later expanding. Retailers reporting weaker discretionary demand. These are early stress indicators, not collapse, but pressure. And pressure builds. When consumers feel squeezed, they reduce spending. When spending slows, corporate revenues slow. When revenues slow, earnings estimates get revised. When earnings get revised, stock prices adjust. This is how macro stress filters through markets. Now let's talk about gold more seriously. Gold is not a growth asset. Gold is a protection asset. When people fear currency debasement, gold rises. When people expect higher real interest rates, gold can struggle short term. But structurally, if deficits remain large and government spending continues expanding, the long-term case for hard assets strengthens. The same applies to silver. More volatile, more industrial exposure, but sensitive to macro liquidity cycles. Bitcoin, even more sensitive. Bitcoin thrives on excess liquidity. When liquidity tightens, volatility increases dramatically. Now here's where this becomes political. Trump wants lower rates. Lower rates stimulate markets short term, but lower rates also weaken the dollar. Weaker dollar raises import prices. Higher import prices feed inflation. If inflation rises again, the Fed is forced to reverse. That's instability. Markets hate instability. And this is why bond markets matter more than political speeches. The bond market decides borrowing costs. The bond market decides government financing costs. The bond market decides mortgage rates. And if bond investors lose confidence in fiscal discipline, yields rise regardless of what politicians want. Now think about government spending. Deficits remain large. Debt continues expanding. Interest payments on that debt are rising. If rates stay elevated, servicing the national debt becomes more expensive. That increases deficits further, which requires more bond issuance, which pressures yields higher. It's a cycle. This is not collapse. This is arithmetic. And arithmetic does not respond to optimism. Now let's zoom out. From 2020 to 2022, we saw extraordinary stimulus. Trillions injected. Liquidity everywhere. Asset prices soared. That was an artificial acceleration. We are now digesting that excess. The hangover phase is never pleasant. Inflation was the first symptom. Now tighter financial conditions are the second, and the system is trying to rebalance. Now here's what you need to understand as an individual. Holding only cash long-term is not a solution. Chasing speculative bubbles is not a solution. Blindly assuming inflation will disappear is not a solution. You need positioning, diversification, ownership of productive assets, cash for opportunity, hard assets for protection, equities for growth. Because inflation compounds, but so does ownership. The same compounding that hurts consumers builds wealth for investors. If inflation is 3% and your investments grow at 8 to 10%, you're ahead. If inflation is effectively 5 to 6% for your household and your savings grow at 2%, you're behind. This isn't emotional, it's math. Now here's the bigger macro picture. We are transitioning from an era of ultra-cheap money to an era of disciplined capital. That means fewer bubbles, more volatility, stronger balance sheets rewarded, weak leverage punished. This is not the 2010s anymore. And investors who still behave like it is are going to struggle. Markets are not collapsing. They are repricing. The difference matters. Repricing can last years. Sideways volatility, sharp drops, fast rallies, uncertainty. But underneath it all, the structure is clear. Inflation slowed, it didn't reverse. Rates are elevated, not restrictive enough to crush inflation, but high enough to pressure growth. Consumers are stretched, not broken, but strained. Government deficits are large, not explosive, but persistent. That's the environment. Now ask yourself, if inflation averages 3% for the next decade, what happens? Prices double roughly every 24 years at 3%. At 6%, they double in about 12 years. That's the power of compounding. And that's why inflation matters more than headlines suggest. You don't feel it in 1 year, you feel it over a decade. And if you're not positioned as an owner during that decade, you fall behind. This is why financial education is not optional anymore. It's survival. You can complain about inflation, or you can understand it and adapt. Because the system isn't changing overnight. The Federal Reserve wants 2%, but 2% still compounds. And if structural forces, deglobalization, energy transition, geopolitical tension, keep upward pressure on costs, 2% may be optimistic. So here's where we stand. Trump says inflation is gone. Powell says progress stalled. Reality says prices are permanently higher. And the only real defense against permanent price increases is ownership. If you found this breakdown valuable, make sure you're subscribed. Share this with someone who still thinks inflation disappearing means prices fall. And if you want to learn how to position yourself properly as an investor in this environment, check the free Investing Masterclass linked below. Because understanding inflation isn't enough. You need to know how to move with it. I'll see you in the next one.